Alright, so this is a video lesson on VWAP, volume weighted average price. I use VWAP a lot when I'm trading because it gives me a better picture of the average price of a stock over the course of the day than simple or exponential moving averages. The reason is because the VWAP, the volume weighted average price, takes into account the amount of shares traded at each price. So if you look at a stock like TMUS, we have this big rip in the last half hour, but the average price traded over the course of the day, even though it's increasing during this period, it's still much lower than the current price. So when you factor in the number of shares traded at this price versus the shares traded over the course of the day, you get the VWAP, and here the VWAP lags behind. Now, the moving averages, on the other hand, it doesn't matter if it's 10 shares or 10 million shares that trade at these upper levels, the simple moving averages are just going to come right up with it. So the volume weighted average price is a little bit of a better indicator of the kind of center or average price over the course of the day, and I use this a lot of times as a level of support and resistance for day trades. So with a stock that rips up really quickly, if I'm thinking about shorting it, my target would be that it returns back down to the VWAP. Now, I would probably take profits along the way at the 9 moving average or maybe the 20 moving average, but ultimately my target would be that it returns down to the VWAP price, which is the orange dotted line on my chart. If we look at a stock like Aria this morning, this had a big breakout on news, and what we notice, which is typical for a lot of stocks, is that you have a breakout and then you have a return down to the VWAP, a return down to the average price, and then some consolidation, and then sometimes they go again, but this is oftentimes a really good area to look for either a re-entry or a short from the extension back down to VWAP. And I also use it I use it for when I'm shorting as well. When I see something that's dropped down really quickly, the first thing I look at is how far are we below the VWAP, because this is going to be my ultimate target, getting up to the VWAP. And you see it happen really nicely here. So we get this nice washout, but if the washout stops and then starts reversing and you're really only like 10 cents below the VWAP, then to me, I don't have enough reward potential to justify the risk of entering the trade. And I like to enter trades with a minimum of a 1-to-1 risk-reward ratio or profit-loss ratio, but the higher the better. So if I can get a nice potential to get 3 times the risk out of this trade, then I'm going to take it. So if my stop is back at low of day and I've got, say it's 20 cent stop and I've got a 60 cent amount of room up to the VWAP, that's a good risk-reward ratio. So I would be interested in taking that type of trade. Now, generally speaking, I use the VWAP more than I use moving averages, but I have both on my charts, and I also use some other indicators. But I find that VWAP is one of the better ones for day trading because it really gives you this good picture of the average price over the course of the day. So it gives you a feel of whether you're buying extended and you have to be a little bit tighter with your stops, or if you're buying something that's way below it and is coming back. It just helps give me a better picture of where the current price is relative to the averages of the day. And you'll notice me referencing it a lot in my trades. My stop is the VWAP or first target VWAP, things like that. And so that's what I'm talking about when I'm saying those kinds of things. Hopefully that makes sense to everyone. If not, feel free to send me a message in the chat room. Okay, thanks.